On June 12, 2025, Air India flight AI-171 tragically crashed, killing a total of over 270 people, including those on board and on the ground. Miraculously, only one person survived such a deadly crash. You might have seen all the news reports about the crash itself and how it happened. But there's one crucial aspect that often goes unnoticed: how airlines manage the massive financial fallout, and specifically, how aviation insurance truly works. We're all familiar with car insurance. We pay premiums, and if something goes wrong, the insurance company covers the damage. But airline insurance works differently and is far more complex. Before we talk about how insurance works after a crash, it's important to understand what aviation insurance actually covers in everyday flying. Operating an airplane, whether it's a small private jet or a huge passenger airliner, comes with big risks and even bigger potential costs. Aviation insurance isn't just one type of policy. It's usually a collection of different coverages, each handling a specific kind of problem. If you want to cover the complete plane for insurance, it is known as Haul All Risk coverage. This is the same as the full coverage you get for your car, but for an airplane. It pays for physical damage to the aircraft itself. This could be anything from a minor dent during ground handling to complete damage in a crash. For a modern plane like the Air India Dreamliner, we're talking about a value that can be over $100 million. If the plane is totally destroyed, the insurance company pays the airline the agreed value of the aircraft. The second part of the aviation insurance is the operator-passenger liability. This covers the airline's legal responsibility if passengers are injured, killed, or even delayed during a flight. This is a very big deal in an accident, as the cost for these claims can be enormous. The third part of airline insurance is the third-party liability. This covers damage or injury to anyone or anything not on the plane. Imagine a plane crashing into a building or a car, or even hitting a bird that causes property damage on the ground. Then, this part of the insurance kicks in for those losses. In the recent Air India crash, which hit a medical college campus, this part of the insurance will be very important for covering the damages and the tragic loss of lives on the ground. The fourth part of airline insurance is the cargo liability. If an airline is carrying cargo or passengers' luggage, this covers its legal responsibility if those items get lost, damaged, or destroyed during the flight. The fifth part of airline insurance is crew personal accident cover. This provides benefits for the pilots and flight attendants if they are injured or killed while on duty. It's like a special accident policy for the flight crew. Now, you might be wondering, with all these risks, how much does the insurance cost? And how do insurance companies figure out the price? Calculating the cost of an aviation insurance premium is a very detailed process. It's far more complex than just getting a quote for your car insurance online. Many factors come into play. It's almost like creating a unique risk profile for each airline and even each aircraft. The factors that are considered in calculating the premium amount are: number 1, aircraft type and age. Which kind of plane is it? It matters a lot. Is it brand new with the latest safety tech, or an older model? New planes cost more to replace if they're damaged, but they're less likely to have any mechanical issues. Older planes might be cheaper to buy, but have higher maintenance risks. Number 2, airline safety record. Airlines that have a history of safe operations, very few incidents, and excellent maintenance programs usually pay lower premiums. On the flip side, an airline with a string of accidents or poor safety ratings will face much higher insurance costs because they're seen as a bigger risk. Number 3, pilot experience and training. The people flying the planes are a critical factor. How much experience do the pilots have? How often do they undergo advanced training? Airlines with highly experienced and well-trained flight crews are generally considered safer bets by insurers, which can help lower premium costs. Number 4, routes flown. Where does the airline fly? Does it operate in challenging weather conditions, over remote areas, or in regions with political instability? Airlines flying into higher risk zones will typically pay more for their insurance because the chance of something going wrong is seen as higher. Number 5, coverage limits and deductibles. Just like with your car insurance, if an airline wants higher amounts of coverage, the premium will be higher. Also, if they choose a lower deductible, which is the amount the airline has to pay first before insurance kicks in, then their premium will be higher. Number 6. Overall market conditions. The aviation insurance world is global. If there have been a lot of major crashes recently around the world, insurers might raise prices for everyone because their overall risk has gone up. This is called a hardening of the market. Now, here's a really important part, a kind of secret in how major airline crashes are handled financially. It's called reinsurance. You might not have heard of it before, but it's the invisible backbone that allows the world's biggest and riskiest businesses, like airlines, to be insured at all. Imagine a single insurance company having to pay for everything after a huge plane crash. We're talking about the cost of a destroyed aircraft, plus compensation for hundreds of passengers and all damage on the ground. That could easily add up to hundreds of millions or even billions of dollars. Most single insurance companies simply couldn't handle such a massive payment on their own. It would just bankrupt them. This is exactly where reinsurance steps in. Think of it as an insurance for insurance companies. Let's see how it works. When a regular insurance company sells aviation insurance to an airline, they don't keep all the risk for themselves. Instead, they share a big part of that risk with other, even larger companies called reinsurers. To understand reinsurance better, imagine this scenario. Let's say a brand new shopping mall opens in Miami, Florida. It's packed with hundreds of high-end stores, popular restaurants, entertainment complexes, and a massive parking garage. The total value of the building, its contents, and the potential loss of businesses if a major fire, hurricane, or other disaster strikes is easily in the hundreds of millions or even billions of dollars. A prominent U.S. primary insurance company, AIG, is thrilled to win the contract to provide comprehensive property insurance for this mall. They've collected a substantial premium from the mall for this policy. However, AIG knows that if the mall suffers a catastrophic fire or hurricane damage, the claims could far exceed their entire financial capacity for a single event. They simply don't have that much capital set aside to cover a multi-billion-dollar disaster all by themselves. So what AIG does is go to reinsurers like Munich Re or Swiss Re and ask them to cover the insurance cost in terms of payment, and AIG pays part of the premium to these companies they collect from the mall. These reinsurers cover the major part of the claim, and the front-end insurer, like AIG, will cover a tiny portion of the claim. Similarly, airlines are huge and need a lot of money for their operations. And for a huge plane crash, the money to pay for all the claims doesn't come from just one company. It's paid out by a whole group of reinsurers, each contributing a small part. For instance, in the case of the Air India AI-171 crash, the main Indian insurers only keep a very small percentage of the total risk, perhaps 5% or 10%. The rest, over 90%, is passed on to these global reinsurers. Without reinsurance, a single major airline crash could easily bankrupt the primary insurance company. When a big event like a plane crash happens, reinsurance helps absorb the shock across the entire global insurance market. This prevents prices from skyrocketing wildly and ensures that insurance remains available for airlines worldwide. So, while you interact with your primary insurance company, know that behind the scenes, a vast and complex network of reinsurers is working to make sure that even the most catastrophic events can be financially managed. In the first hours and days after a crash, the airline and its parent company often make quick ex gratia payments. Think of these as immediate goodwill gestures or interim relief. They are not the final compensation, but they help families with immediate needs during a terrible time. For the Air India AI-171 crash, Tata Sons, Air India's owner, quickly announced 1 crore, about $120,000, for each deceased victim's family, plus an additional 25 lakh, about $30,000, as an interim payment to families and the lone survivor. These payments come from the airline side first, but ultimately the insurance policies cover them. Before any major final insurance payouts can happen, a thorough and detailed investigation into the crash is absolutely essential. In India, the Aircraft Accident Investigation Bureau, AAIB, takes the lead. They are an independent body whose job is to find out what happened and why. They will recover and analyze the black boxes, the flight data recorder, and cockpit voice recorder, which hold vital information about the plane's performance and crew conversations. They'll also look at maintenance records, weather conditions, witness accounts, and even pieces of the wreckage. Their investigation findings are critical because they directly tell the insurance companies who is responsible or liable for the crash. This directly affects how much money gets paid out and by whom. One of the first and usually most straightforward claims to be settled after a major crash is for the aircraft itself. Once the plane is confirmed is completely destroyed, a total loss, the hull all-risk coverage kicks in. The insurance company pays the airline the agreed insured value of the aircraft. For the Air India AI-171 Boeing 787 Dreamliner, which was insured for about 1,079 crore, around $125 million, this payment is being processed. This kind of claim is typically settled much faster than claims for people or property on the ground. While the aircraft's claim is relatively simple, compensating for lives lost and injuries suffered, both on board and on the ground, is far more complex and can take a long time. For international flights, like Air India AI-171, which was headed to London, passenger compensation is mainly guided by an international agreement called the Montreal Convention of 1999. India is a signatory to this treaty. It works in two main parts. Strict liability, Tier 1. For the first part of the compensation, airlines are held strictly liable. This means they have to pay up to a certain amount per passenger regardless of who was at fault. As of late 2024, this limit is 151,880 special drawing rights, SDRs, per passenger. An SDR is a special international money unit. This translates to roughly 1.5 crore to 1.85 crore, or about 171,000 to 211,000 USD per deceased passenger. The family does not need to prove the airline was negligent to receive this amount. Unlimited liability. Tier 2. If the damages are proven to be more than the SDR limit, the airline can be held liable for unlimited compensation. However, for this to happen, the families usually need to show that the crash happened because of the airline's or someone else's, like a manufacturer's, negligence. Third-party liability. This aspect of insurance is extremely important in Air India AI-171's case. Since the plane crashed into a medical college campus, there were fatalities and significant property damage on the ground. The airline's third-party liability insurance will cover these damages and compensations for the ground victims and destroyed property. Proving the extent of these damages and identifying all affected parties can be a long and complex process. Unlike the quick haul claim, liability claims for passengers and third parties can take years to fully settle. The total insurance payout for the AI-171 crash is estimated to be around $475 million, approximately 3,940 crore, making it one of India's costliest aviation disasters. This massive sum includes about $125 million, 1,079 crore for the lost Boeing 787 Dreamliner itself, and an estimated $350 million, 3,021 crore for all the liabilities mentioned before, covering both passenger compensation and the significant third-party claims from the ground. In the case of the Air India crash, Tata AIG General Insurance is the main insurer. As explained earlier, the insurance costs for airliners are massive, so if only one company decides to cover the cost, then it would most probably bankrupt them. So Tata AIG also has co-insurers and reinsurers. The co-insurers in this case are United Insurance, Oriental Insurance, National Insurance, and ICICI Lombard. The reinsurers in this case are AIG, specifically AIG London. So far, they haven't released a full list of all global reinsurers. But in aviation insurance, Munich Re, Swiss Re, and Lloyd's of London are the big players. These reinsurers will pay 90% of the amount, and around 10% will be paid by the lead insurer, Tata AIG. While people affected will interact with Indian primary insurers like Tata AIG, the financial hit for this catastrophic event will be overwhelmingly absorbed by a network of powerful global reinsurers, led by entities like AIG London. This global risk sharing is precisely what allows for such massive coverage limits in the first place, ensuring that even in the face of immense tragedy, the financial system can respond without bankrupting any single entity. Every major plane crash sends ripples through the global aviation insurance market, and the Air India AI-171 crash is no exception. When a big loss like this happens, the insurance market tends to harden. This means that insurers and reinsurers become more cautious and less willing to take on as much risk. As a result, they increase premiums. Airlines around the world, especially those operating similar types of aircraft like the Boeing 787, are likely to see an increase in their annual insurance premiums. Experts suggest that Indian Airlines, for example, could see their premiums jump by 10 to 30% when their policies come up for renewal. Insurers will demand even more detailed information about an airline's safety procedures, maintenance records, and pilot training before offering coverage. They might impose stricter terms and conditions. Ultimately, for airlines, higher insurance costs means higher operational expenses. In the long run, these increased costs might unfortunately be passed on to passengers through slightly higher ticket prices, making air travel a bit more expensive for everyone. So, if an airline crash happens anywhere in the world and for any airline, for example, if an Air France plane crashes, or a British Airways plane, or any other airline's plane crashes, there's always a possibility that the insurance premium for all the airlines in the world can go up depending on the severity of the crash, ultimately affecting the extra ticket price paid by passengers. So you as a consumer living in any part of the world might get affected by any plane crash all over the world. So next time you board a flight, remember behind that ticket lies a massive global financial web designed to protect against the unimaginable. Thanks for watching. If you're new to the channel, then subscribe and check out other videos to learn about the world of finance and money.